Welcome to the Daily Update, where I'll go over the action in the market for Thursday, April 20th, and then we'll see how things look for Friday, April 21st. We had a bit of a down day. Unfortunately, some of our charts are starting to show some weakness. We still have some overbought indications, although a lot of those have been worked off. We even have one indicator that's extreme negative already. We still have this positive backdrop, but the market's going to need to come in and take prices higher to maintain that. If we see follow-through weakness, we might be starting to see a shift more over to the negative side. Before I get started, this will be the last video that I do before I get set to do some traveling. So please be aware of that. I'll post the videos as best I can while I'm on this trip. I also have a podcast that's available, and in the description is a PDF of all the slides and charts that you can look at. I do have a private Facebook group that you're welcome to join. I do have a poll that is posted, and I'll look at that sometime over the weekend and post the results when I can. And I'm still having a little bit of trouble uploading things to Rumble. I'll try the best I can to get the videos uploaded as soon as possible. Let's go back and talk about what happened. Right at the open, we had a gap lower open. We fell down below S1 at 41.38. We went all the way down to S2 at 41.22. Prices then rebounded back up to S1. As the day went on, prices remained below S1 before climbing almost up to the daily pivot. There was an attempt at some kind of a rebound. The daily pivot was at 41.51. Then prices declined, and this is when we saw some real intense selling. We went down below S2, we hit 41.15 before we rebounded slightly to take prices back above S2 at 41.30. We were down 0.60% overall, and volume was about average. We saw a little pickup. Now, Friday is options expiration, so we're likely to see an increase in volume with all the jockeying that goes back and forth, and that may be adding to some of this roller coaster ride that we're seeing right now. As I said, the technicals are still positive, but we need to see some follow-through upward action for it to maintain that positive posture. The markets continue to be focused on inflation and interest rates, and then we're having earnings reports that are coming out, and most people are focusing on that as well, and then wondering if we're going to get any more banking information. Here's the intraday chart showing how we gapped down below S1. We immediately fell down to S2, chopped around a little bit between S1 and S2, tried to make a recovery, didn't get back up to the daily pivot before we saw some weakness coming in. Eventually, we fell down below S2, and then we saw some rebounding going into the close above S2. Here's a look at large cap growth versus value, how they were both weak as well. And on a closing basis, growth actually performed a little bit better. It was down less with the large caps, mid caps, and small caps, even though both were down. Here's the intraday chart of the SPY. We started to show some weakness in the overnight session. Then things got much weaker as we got into the pre-market. We ended up opening lower. We tried to rebound up out of that, but then saw some weakness, only to be followed by some late day strength, and we're drifting slightly lower in the initial overnight session. What are some comments that we can make? Bank stocks were weak after there were disappointing earnings from a lot of the regional banks that reported. New York Fed President Williams, who is an FOMC voter, came out in support of another rate hike at the next FOMC meeting. Cleveland Fed President Mester also implied in an interview that further tightening is needed. So taken together, the markets didn't like that very much. Value was weaker than growth, or you could say growth was a little bit stronger than value, even though they were both negative. The S&P may be beginning to shift negative. I'll go through the charts and show that to you. We're still positive, but we're starting to see some cracks in this positive stance. If we see further weakness, that'll just shift things more down going forward. On a short-term basis, only the stochastics now are showing any extreme positive readings. We also have the Stoch RSI, which has already gone extreme negative. On an intermediate-term basis, only the TTM squeeze that we're keeping an eye on, and even that's not a real major signal. The dollar was down, and interest rates were also down in the session. Should have added some support to stocks, but it didn't end up doing that. The 30 to the 5 is back to being normal, where all of our other yield curves remain inverted. Sentiment is positive. It's still giving us a reading of 64, but it did drop from 67. Our trend is positive, but it's weakening because the green line's going down. The ADX itself continues to strengthen because it's above the moving average, but we are below 20, so we're still chopping around pretty much in a trendless environment. Our bias is mixed, and I've kept our momentum at mixed. Economic reports that came out. Weekly jobless claims came out at 254,000, a little bit more than the 242,000 they had expected. Continuing claims, and we're going to need to start watching this a little closer, they increased to 1.865 million. The Philadelphia Fed Index, and this was kind of a negative thing that really hit the markets. It came in down 31.3. They expected it to be down 20. Last time it was down 23.2. Anytime we've had a reading below negative 25, this has signaled a recession going all the way back to 1970. Existing home sales also declined 2.4% on a month-over-month basis. Seasonally adjusted, that works out to 4.44 million, where they expected 4.5 million. Last time it came in at 4.55 million. Sales were down 22% from the same period a year ago. And then we had the leading economic index that's also feeding into this idea that we will likely go into a recession. It came in down 1.2%. They expected it to be down 0.4%. Last time it was up 0.5%. Here's the weekly jobless claims showing how they're starting to go back up. We really pay attention to this blue line, which is a 4-week simple moving average. Continuing claims are also starting to go back up. Is there some weakness that's developing in the employment situation? This would suggest that there possibly is. So we'll be watching for other employment indications that we follow. Looking at some Isabel Net charts, they say long big tech stocks is the most crowded trade. That's where everybody's at right now. Cumulative fund flows showing that a lot of funds are going into money market accounts, followed by government bonds. Those seem to be more favorable now. You have less going into equity, actually a decline here, and even less going into corporate bonds. Where do you see the S&P by the end of the year? 54.7% say that we'll be down at 3,500, which is below where we're at right now. This tries to take an alternative view of volatility. The black line here is the S&P 500. The red line is the 12-month count of daily changes of minus 1% or lower. And it just shows that we haven't dropped all that much. We've been dropping less than 1% on down days. The current forecast for GDP from Goldman Sachs still has them being positive on GDP. The black diamonds here are the consensus where they expect that we will have negative GDP in the third quarter. The next chart just talks about dividend futures are pricing unrealistic dividend growth. This is what the forecast is from Goldman Sachs at 6.2%, where the futures market is saying, no, it's going to be much lower than that at about 1% growth. The next chart just shows that there's a lot of pessimism right now in real estate, and the numbers are pretty much reflecting that. This chart just shows the S&P 500 sectors that have made announced buybacks. Energy is in the lead, followed by financials, then communication, and then we go on down the line. What will be the likely source of the next big bad credit event? Most people are saying that it'll happen in commercial real estate, not only in the US, but also in the EU. Edward Yardeni had his take on the leading economic indicator. The red line just shows how it has been coming down. Looking at our charts, the Ulster Index still suggests that there's not a lot of fear in the market. Here's the VIX. It did tick up a little bit with the line chart and on the bar chart. But this is telling a different story. We're seeing the VIX of the VIX really starting to pick up. It could be because we're getting into options expiration, but this is suggesting that volatility of the VIX could be getting ready to go up, which probably means there's some pressure on the market. The VIX of the VIX, after being extreme negative, is now starting to bounce back up, and we're wondering, has the VIX now hit a bottom so that if it starts to go back up, typically that means stock prices are going down. The SKU index, after really starting to spike up, is now coming back down, suggesting that out-of-the-money options are still predicting a fairly big event overall, but it's not extreme. Equity put-call ratio ticked back up slightly. Another fear gauge that we look at is still in a downward trend overall, but did tick back up in Thursday's session. This next chart also shows that there's not a lot of fear in the market right now. Folks are still tending to favor a risk-off posture, meaning they're getting into bonds and getting out of stocks. Looking at the condition of our trend, the green line is coming down, but it's on top, so that's positive. We're above the moving average with the ADX, so it shows that the trend is getting stronger, but we're still below 20 overall. The Arun, after topping out and coming back down slightly, is now starting to go sideways. Looking at the daily chart, after coming up to what could have been counted as overhead resistance, we never even really got there. We're starting to come back down. We do have some support at about the 4100 level. If we continue to fall, we'll be looking at the 50-period moving average. On the bottom, you can see where volume picked up, and it was just about at average. The moving average study, after being extreme positive, is now starting to come down with the 20. We're rolling over a bit, but still positive with the 50 and 200. The slope is starting to show a little bit more weakness. Our other oscillators are still pointing up, but a few of them are beginning to roll over. So we're still positive in the long and intermediate term, starting to show a bit of a decline in the short term, although we are still positive. The Stochc RSI, after being extreme positive just a day or two ago, is now getting down to an extreme negative reading. The Williams percent R has now dropped and is no longer extreme positive. Here's the stochastics in the short term, starting to come back down, no longer extreme. We're still extreme in the intermediate term, even though we declined, and we're also extreme in the long-term stochastic. The force index is still above 0, but it is declining. We're still above all plotted moving averages. We'll also be keeping an eye on the 20-period moving average to see if that acts as support if prices continue to fall. Here's another big warning sign with the parabolic SAR. We have a dot on top. Swell trading oscillator starting to turn down based on price and volume, and we're still working off of this negative divergence between volume and price. The vortex is still positive, but the green line is coming down as the red line is coming up. The Sean trend meter is no longer extreme positive and starting to fall. The Chaikin oscillator also is turning down, but it's still above 0. The S&P to utilities ratio also not really showing any strength. It's not breaking down yet, but it didn't go up in a good healthy rise for the S&P. The PMOs that are rising is now starting to fall. We're just coming off an extreme reading with the buy signals, and we're doing okay with the percent of PMOs that are above 0, but this could be starting to flatten out, if not roll over. The BPI is still above 50 and advancing overall, so that remains positive. And the NYSE bullish percent index continues to climb above 50. That's positive. The Chaikin money flow continues to be positive. The balance of power, even though it declined, is still positive. Here's the TTM squeeze with the darker shade of blue bars. They continue to go down. The go-no-go system has switched to a lighter blue bar, which is neutral, and we're still above the anchored moving average going back to the all-time high. We also came down and hit this triple exponential 50-period moving average, which acted as support. And if we do keep falling below those moving averages and come down to this other anchored moving average, we're looking at 40.75 as potential support. The short-term fib levels were still above this 41.23 level, and we closed above it even though we fell down below it briefly in Thursday's session. Longer term, we're having a hard time breaking through this upper resistance at 41.56. Longer term, if we continue to fall, we're looking at support at the 40.20 level. Another area of upper resistance is shown in our quadrant lines chart where we were not able to break through this level. The equal weight index continues to underperform the S&P, and the big stocks, after really outperforming, have now been chopping sideways in their performance. The Elder Impulse system for the S&P remains neutral. The McClellan oscillator is declining, but still above 0. Broader range McClellan oscillator continues to fall, but is still positive until we drop below 0. The summation index based on price is still doing okay, but we're rolling over based on volume. The top part of this chart and the bottom part of this chart are calculated differently, and sometimes we get a few days advance notice when the volume summation index starts to turn down. It also can give us some false signals, but sometimes it's also a leading indicator for us. The Heikin Ashi, after having a lot of open bars, is now turned to a black bar. That's negative. And the Kegi is still positive, but the black line is pointing down. Looking at the new take on Dow theory, where the S&P was able to break through this blue line, it's now starting to come back down. The Nasdaq was not able to break through this double top that we've been watching. The transports continue to underperform the Dow. New highs, new lows saw a little bit of an expansion of new highs, but we're still rolling over with our 5 period. we're flattening out to only going up slightly with our 10 period. The advanced decline line, we've been working off of this negative divergence between price and volume, where we're turning down slightly based on price as well as volume, but with both, we're still above their moving averages. The advanced decline line for the NYSE is still holding up fairly well. We're still seeing this longer-term negative divergence where the NYSE common stock advanced decline line made a higher low based on price, but a lower low based on volume. The advanced decline ratio is dropping, but still above zero. Accumulation distribution is still above the moving average. That's positive. Volume picked up just slightly as we're heading into options expiration. The money flow index is starting to turn down, but it's still above 50. The ultimate oscillator also declining, but above 50. On balance volume still above the moving average, even though it did decline. We're watching this for our longer term trend. We're just starting to see what could be a cross with the special K. So that would be longer term positive if we break above this moving average. The financials continue to show a little bit of improvement compared to the S&P, but are still in a downtrend overall with the ratio. And the financial sector continues to show a lot of weakness. Looking at a broader measure of the advanced decline line, we're still above the moving average with the NYSE, the S&P, and the mid caps, where we remain below the moving average with the small caps. The Dow never was able to get through this R1 level and is now starting to fall back down. The diamonds for the Dow remain at neutral. The Nasdaq was not able to break above this double top, which now may be considered a triple top. And the Nasdaq 100 has pretty much been chopping sideways without being able to climb higher. The Qs have now switched to negative for the Elder Impulse system. We're still above this 38.2% retracement level for the Nasdaq 100. If we fall, we're looking at the 12,864 level. We're still above the anchored moving average going back to the all-time high. This support is at the 314 level for the Qs. Even though there was a decline for the micro caps, we did not set a new 52-week low. The small caps continue to decline below their 200-day moving average. Here's the Russell, showing how we're turning down but still above 50 with the RSI. The MACD is still positive, but also showing how we were not able to get above the 200-day moving average. The small caps have also switched to negative for the Elder's Impulse system. The small caps continue to underperform the S&P 500. The mid caps are still chopping along the pivot level. They're still above their 200-day moving average, but they remain below the 50-period moving average. The Elder Impulse system for the mid caps remains at neutral. The home builders did have a good day on Thursday, and so the ETF itself is going up, and we're seeing some improvement with the ratio overall. And the home builders and the S&P have a very strong correlated relationship, meaning that they're going in the same direction. The Copic curve buy signal has now gone, and the Prang bottom fisher buy signal has now gone as well. Bond yields were down, and we're coming down to the 200-day moving average. Will they bounce up off of that? And bond prices were up on the day. The RSI has now crossed back above 50. The MACD is still showing a downtrend. The MOVE index ticked down just slightly on the top, where the VIX ticked up just a little bit, but their correlation between the two is still very strong. Also, looking at the S&P compared to the TLT, which is a long-term bond fund, there's a real wide spread between these two. Now that we're seeing the S&P turning down and the TLT turning up, their relationship is having a tendency to go in the opposite direction, where typically that's not what happens. So we'll be waiting to see. Are we going to see more strength in bonds and more weakness in the S&P? Our long-term trend is still intact right now. As long as we're above this downward sloping trend line, the uptrend is still looking valid. The MACD also points that out and continues to be positive. An update of our possible positive scenarios. We're still extreme positive with the 10-day average of the highs minus the lows. That's a sign of strength that so far we've been able to stay at this area, even though we've seen some weakness in the market over the past couple of days. The ZWAG NYSE breadth thrust is still producing a buy signal recently that remains on the books going forward. And these are the returns looking out 1, 3, 6, and 12 months. This has been negative all along, where we look at the Amex, the Nasdaq, and the NYSE. Then we take a 5-period moving average of the highs minus the lows. They continue to be below zero. Looking at our ratios, the Qs to the S&P are now starting to show some weakness. The discretionary is also turning down when compared to the S&P. Large cap growth versus large cap value, they're pretty much on top of the moving average. Our growth value ratios for the large caps on top of the moving average, showing some weakness with the mid caps and a little bit of weakness with the small caps. Our 50-period exponential moving average of the new highs minus the new lows still remains positive. This is a slower indicator, and the indicator itself is still above zero. The 2-year Treasury yield, we're wondering if this spike and then coming back down will give some support to stocks. It already did that once. If we continue to fall, will stocks be able to pick up on that and go higher? And then looking at our staples, the S&P 500 ratio, we're wondering if these two spikes are legitimate, but we're starting to come back up with this ratio. And if we continue to go up, that may set a new spike. So what's our outlook for Friday? Earnings season is here. The technicals are positive, but maybe starting to show some weakness. The preliminary IHS market manufacturing report, as well as the services report, will be coming out. The geopolitical events, of course, the market is still fixated on inflation and interest rates, as well as earnings now. We do have another speech that will be happening on Friday. All the other speeches have concluded. The Friday speech will come after the market closes. Looking at the Stock Traders Almanac statistics for the 21st, we're neutral to positive with the Dow being up 57.1% of the time. We have more of a negative slant with the S&P 500 being up only 47.6% of the time, and the NASDAQ is a little more positive, being up 52.4% of the time. We still tend to be positive overall in the month of April. Here are the backdrops that we're looking at that apply to the whole year, hoping that they may provide some support to the market in the longer term. We're on the 13th trading day of the month, where we do see some advancing during a pre-election year. So our scenarios, can't really go with the down one because our technicals are still positive, but we may be starting to show some weakness. Can't really go with the up one because of this weakness that we're seeing and a lot of overhead resistance that we just can't get through. So we're defaulting to the sideways trend because our ADX is strengthening. It's above the moving average, but it's still below 20. The green line is on top, so that's positive, but the green line is also declining. So looking at our warning signs, volume still remains below average overall, even though we had a pretty good day on Thursday. The S&P may be starting to weaken. The VIX is still showing a lot of complacency overall. The S&P is underperforming utilities. The summation index based on volume has turned down. The S&P new highs, new lows are lagging, but possibly showing some improvement. We're still in a risk-off posture. The small caps continue to underperform. The NASDAQ may be declining from a double top, or you could even say a triple top. And earnings season is underway, which could be positive or negative depending on which way the wind blows. So our conclusion, the S&P is positive but maybe starting to weaken. In the short term, we're showing some weakness. Intermediate term, maybe showing even more weakness. As long as we're above the moving average, though, in the long term, we're still positive overall, and we had a recent golden cross. Thank you. I hope you found this helpful. As I said, I will produce and post the videos as I'm able to do that while I'm traveling. There'll probably be pretty lean videos over the weekend since that's the bulk of the travel time that I will have. But I'll try to get what I can together and present that to you just as soon and timely as possible. Have a great weekend, and I will talk to you in the next video.